Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, November 19th, 2025. I'm going to begin with the dashboard. This is a view of the the world markets. 4 U.S. equities indexes, Dow, S&P, NASDAQ, and Russell, and 2 foreign ETFs, EEM and EFA. EEM is the emerging markets, kind of combined into one ETF, and EFA is the developed markets, primarily Europe and Japan, maybe South Korea. And giving, just from those ETFs, giving a view of what's going on in those markets. So, and then the long-term government bond, TLT. In the yellow box are the results from this past week, mixed. Some up, some down. In the pink box, this is the year-to-date, and the order that I put them in is the year-to-date numbers. And EEM, emerging markets, number 1 by quite a bit, a gain of 31% this year. And EFA, 25, almost 26%. And then you get to the U.S. markets, 18, 14, 10, and 7. So in other words, U.S. markets have way underperformed the international markets. That is typically not the case. It's also typically not the case that the emerging markets leads, or for that matter, even it outperforms the developed markets. But in this particular year, it has. To the far right are the green dots and red dots. Green dot meaning it's above its 20, 50, 100, or 200-day moving average, and red meaning it's below. Red is a more bearish indicator, and green is more bullish. When we get to the S&P 500, now we just take the S&P and break it apart into its 11 major sectors. The yellow box, again, shows the last week. Very mixed. Some up, some down. Year to date, pretty much all except the last one are positive, meaning technology, telecommunications, industrials, healthcare, financials, etc. And then to the right of that, it's kind of surprising to me, but there are quite a few red dots. A lot of these are below their moving averages. So we have 25 out of 44 that are positive. I guess that's 19 that are below their moving averages. So not the healthiest sign that we've ever seen. This is the chart of the S&P 500 for the last 3.5 years. We've had some down days. Down days have been followed by up days. So when you look at it on a day-to-day basis, it kind of makes you dizzy. But when you look at the very far right, the upper right, it came down a little bit last week and then kind of flattened out this week and is still a fair amount above its 20-period moving average. So when you look at it on a weekly basis, it's not that weak. Matter of fact, it's strong. Nothing here shows weakness. And I put that on a candlestick basis, and again, there's it looks the same, except it shows you the more negative weeks with a red candlestick, or a positive week with a hollow candlestick. This is this year. Now change it from a weekly chart to a daily chart, because I'm only dealing with 2025. I can do that. It still puts a lot of little candlesticks in there, but it tells a little bit different story. From the beginning of the year, it was going up for a while, and then it came back down to, I think, April 7th. And from April 7th forward, it's gone up. But you can see at the very far right, it's starting to move up and down some. So is this a consolidation, and is it going to go on back up, or is it going to break down and go on down below the moving average? I don't know. I think it's going to consolidate, and my feeling is it'll probably go up from here, but I don't know that. It could go down. On a relative strength basis, the NASDAQ 100's the numerator, S&P 500 denominator. If it goes up, that favors the NASDAQ, yes, and then if it goes down, it favors the S&P. During the past, looks like 2.5 weeks, two or 3 weeks, it has come down. And what that means is that it does not favor the NASDAQ and does favor the S&P. During that period of time, we have shifted from, I don't know how long ago it was, but we shifted from the NASDAQ, which was in favor for quite a while, and we shifted over to the Dow, which is a more value-oriented, sometimes more defensive-oriented index. Same thing here. SPY-G showing the growth side and SPY-V showing the value side. It's a little more jumpy because we isolate it into these two extremes. Again, at the very far right, we shifted to value in our strategies, and that shows here where value came into favor, and we're still in value. And so I don't know if that'll change, but right now that's the way it is. So the next one is compares large cap, the S&P 500, to small cap. When it goes up, that favors the S&P, large companies. When it goes down, it favors small companies. During the past 2 or 3 months, up till about a month ago, it was going down, and you can see that at the very far right, upper right. You see that it broke through the moving average and came on down, and then for the past 3 or 4 weeks, you can also see it shot straight up, which means large cap came back into favor. The dollar has been under pressure since January 1. It has rallied a mild rally, rallied since the summer, and has gone back up over the 20-period moving average. It doesn't look like a lot of strength there, but it is better than continuing to go down. So S&P, the dollar, in my opinion, is still looking weak. This is interesting to me because this takes the U.S. stock market, the proxy, which is the S&P 500, puts it on a relative strength basis to EWY, which is the South Korean stock market. It's the ETF that represents the South Korean stock market. And using that as a proxy for international or foreign markets. I put a black arrow that began in late December of last year. So for about 10 months, the S&P 500, the U.S. market, has gone down relative to foreign markets, and in this case, the South Korean market. A pretty big, dramatic move down for the U.S. and up for South Korea, particularly when you look at up to that point, it had been favoring on a pretty regular basis the U.S. stock market, and now a big correction. Volatility index, the VIX, goes up and down. I did not put an arrow on here because there is no clear pattern of which way it's going. A lot of up and a lot of down. Long-term government bonds continue to be under pressure, and that's because of interest rate increases or perceived potential increases and or bond yields, which tend to track with interest rates. So I put a black line from the beginning of all the way back to when this number, which is for TLT, is around 88. You have to go back about 3 years before you see 88 again. And it has gone above that line and below that line, really showing for 3 years that the bond market, particularly the long-term government bond market, has gone nowhere. It is flat. It's gone up and down, but it has not moved in an upward or downward direction. When you have a 60-40 stock and bond portfolio, remember that's your 40% or something like it. Now, it could be corporate bonds and it could be intermediate term government bonds and so forth. But in general, bonds are doing something like this. That's 40% of your portfolio if you're in a 60-40, which is a reason why I'm not in favor of 60-40 stock and bond portfolios. And by the way, TLT, the long-term government bond, before it started going sideways, dropped from its high about 50%, and then it decided to go nowhere. So not an impressive part of a portfolio if it is a significant part, in this case, 40%. I wouldn't want 1% in something like this. Okay, Bitcoin has broken down. It is moving in not a sharp downward direction, but is moving somewhat downward. It went up above, Bitcoin itself went up above 100, and now it's struggling. I don't know, is it going to recover from here and go on back up? It may. I'm not a Bitcoin person, so I don't follow it. I don't recommend it. But I know there are people who do, who are very much in favor of it, who think it's going to become the next currency and will replace the dollar or be an alternative to the dollar. I don't know. That's where it's going for now. Gold is still on a tear. In the last 3.5 years, you could say the last 3 years, it has gone up and it is still well above its 20-period moving average. It did correct, and you see that at the upper right, and then now it's going back up. Silver, even more so, had a long-term run, and especially during the past 6 or 8 months, corrected. You see that at the very upper right, and then has now started moving back in an upward direction. I'm going to give you a new chart. This is something you haven't seen before. I thought I would put silver and gold on a relative strength chart so you could see relative to each other how they're doing, and there's a little bit of both. The black arrow shows that when it goes down, that favors gold. In other words, gold is going up more than silver is if it is declining. The red arrow to the right shows that silver is outperforming gold since about April of this year. So that would be in the neighborhood of 7 months. So pretty interesting. So we saw both of them go up a lot during the past 7 months, but silver even more so. The spot prices as of last Friday, November 14th, were gold back up over 4,000 an ounce, 40.81, an increase of 2.5% from the previous week. Silver up over $50 an ounce to 50.51, a 4.7% increase from the previous Friday, bringing the gold-silver ratio to 81-1. Now, that ratio has been as high as over 100-1 recently. And it's fluctuated a lot between, I'll say, 70-1 and 100-1. And for a while, it's been in the 80s. When silver, or when that ratio, gold over silver, is above 30 or 31, especially where it is today at 81, that favors silver as a better buy, meaning that silver has got more to go on the upside than gold does, typically using historical patterns. It is believed that when that ratio gets down to 31 to 1 or in that range, let's just say low 30s to 1, that it favors gold as a better value. In other words, gold has a chance to go up more than silver, or if they go down, gold has more resistance and more staying power than silver does at that point. A monster box of silver, 500 rounds of pure silver, is $26,875. If you buy silver, it's a good way to buy it. Now, if you want to buy lesser quantities, you want to buy a tube of them, 20 to a tube, you can certainly do that, or several tubes. But if you have the resources to buy a box, $26,875, that's gone up. We saw that within the last year, down around $11,000 or $12,000. So it has definitely gone up a lot. That includes a $2.64 premium, bringing the retail cost at $53.15. Now I want to stop and make a comment here. My son, Preston, is in the precious metal business, so I talk with him, and I buy my silver. I don't buy gold at this point. I buy silver from him, and I pay the retail price, whatever he's charging anyone else. I tell him to charge me the same thing, and I buy it from him because he's my son. But I also have found out that he is very, very competitive. So I have a client who called me this last week, and said, I want to buy another box. And I said, okay. So I arranged for the money to be available. And today, actually, we're moving that money over to Preston to send another box. I checked his prices because I make this statement from time to time. I want to make sure I'm right. I'm glad to promote his business, but I'm not going to misrepresent that. So his price on Friday was $53.15 per round for a box. I checked SD Bullion. SD Bullion is known as the discount online retailer. I think of them kind of like Amazon. Heavily discounted as much as they can, and a lot of people buy their silver or gold from SD Bullion. So as soon as I knew this, $53.15, I checked SD Bullion's website for generic silver to see kind of where Preston's prices were relative to them. And they were about $1 higher than Preston. They were around 54. I take that back. I'm sorry, I don't remember. Either it was around a $0.50 or $1 higher than Preston. It was 54 something. I want to say, I don't want to misquote it. So over $54 for a generic round on Friday. So why are his prices? He's a retailer. He's in Gallatin, Tennessee. He has a storefront. And how does a guy like that so much more competitive than SD Bullion? Well, first of all, they all buy from the same wholesalers, number one. And number two, he has virtually no overhead. Very low overhead for his shop, no salaries, just himself, and no advertising. SD Bullion does a ton of advertising and a huge amount of salaries. So they are competitive. They are better than the vast majority out there. But Preston continues to tell me, Dad, I check their numbers and I'm consistently below them. And I saw that myself. So I'm saying that because, one, I love to help him and promote his business if I can. And secondly, I want to help you. If you're going to buy this, I want you to know about this because it's a good deal for both parties. And there probably are others that are low overhead retailers, brick and mortar, who pass that savings on to their customer. There's others who are low overhead and they don't pass it on. So just do your homework. So my 2 cents worth, I wanted to take that opportunity to say what I saw on Friday. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.